Ever felt the adrenaline rush after finding the perfect stock? That feeling, while exhilarating, can often be your biggest enemy in the world of investing. In our previous discussion, I shared how to search for quality businesses to invest in. While that is a critical first step, the next three are just as important to turn your investment into a potential multi-bagger. They are: start with small positions and buy in tranches. Purchase businesses at a cheap price. Be patient and wait. Let's begin by discussing how to protect yourself from the downside. No matter how meticulous your research, blind spots are inevitable in investing. Even seasoned analysts can overlook critical details, especially in unfamiliar industries. This reality underscores the importance of a prudent, phased investment strategy. Businesses operate in inherently uncertain environments. Despite management's best intentions, unforeseen challenges can derail even the most promising ventures. This is where strategic tranche buying becomes your financial safeguard. Consider Shopify's misadventure with its fulfillment network. The company's scalable, sticky business model was appealing, and the pandemic accelerated its growth. However, the 2022 acquisition of Deliver marked a fundamental, capital-intensive shift from its core software-first model. This strategic pivot dragged down Shopify's financial performance and distracted its core business. The market reacted mercilessly, confirming fears about the company's new capital-intensive direction. Shopify's share price lingered below half its peak for an extended period. It took strong financial performance and the sale of Deliver in mid-2023 for the stock to rebound. This example highlights that even great companies can make costly strategic errors. The investment world is messy, a dynamic interplay of short-term traders and long-term investors. Buying in tranches isn't a sign of hesitation, it's a strategic advantage. It allows you to manage the unexpected and leverage market volatility. This approach provides room to reassess your thesis and acquire more shares at a better price if a quality business goes on sale. A great business at an exorbitant price rarely makes a great investment. Overpaying can severely limit your returns even if the company continues to perform well. The analytical challenge lies in determining what constitutes a cheap price. The discounted cash flow method aims to find a stock's intrinsic value. In theory, this is the present value of all future cash flows. However, relying solely on online DCF calculators can be misleading, creating a false sense of security. DCF models are highly sensitive to input assumptions. Slight changes in projected growth rates, terminal growth rates, or discount rates can drastically alter the calculated intrinsic value. This sensitivity makes accurate forecasting incredibly challenging. Therefore, I prefer using relative valuation metrics. Examining a stock's price-to-earnings (PE) ratio against its historical average, industry peers, and growth rate offers a practical perspective. Replacing earnings with free cash flow can provide a better reflection of the company's actual financial health. The price-to-earnings to growth PEG ratio is particularly useful, quickly gauging if a stock's PE is justified by its growth prospects. A PEG ratio below 1.0 is often considered undervalued, but context is crucial. A slow growth utility might be fairly valued at a PEG of 2.0, while a hyper-growth tech company could be a bargain at 1.5. Never base your investment decision on a single metric. Combine quantitative analysis with a thorough qualitative assessment of the business. For instance, I recently increased my stake in Intuitive Surgical despite a high PEG and forward PE. Was I crazy to pay so much for Intuitive? Maybe, but hear me out. I was impressed by Intuitive's robust and measured roll out of its latest Da Vinci 5 machines. This signals sustained future growth primarily driven by its expanding installed base and recurring revenue stream, which makes up over 80% of total sales. And guess what? Despite the perceived lofty valuation, its current PE is lower than its historical average PE of over 60x across various timeframes. Hence, I think Intuitive deserved to trade at a premium. I could be crazily wrong, and that's why I went back to the second principle and increased my stake only by a small amount. The big money is not in the buying and selling, but in the waiting. This profound statement by Charlie Munger encapsulates the essence of long-term investing. Inaction, while seemingly simple, is often the toughest discipline to master. A business's true potential rarely materializes overnight. It demands unwavering patience. Consider the multi-year horizons required for significant returns. iFast took 3 years to make iFast Global Bank profitable. The Hourglass waited 7 years before finally executing its major expansion into Australia in 2020. Arista Networks required 6 years to deliver a 10-bagger return for me. If you are genuinely investing for the long term, you must be ready to play the patient game. First, you need to search for potential, then you need to check valuation, and finally be patient for the growth story to unfold. But is all that work worth it if you only get one 10-bagger after 6 years? Should you just invest in a world or US ETF instead? Stay tuned for the final video in this series, where I'll answer these questions. If you found this helpful, don't forget to like, share, and subscribe. See you in the next video.